With me today, I have Bruce Stout, manager of the Murray International Investment Trust, which is included on Interactive Investor's Super 60 rated list. Hello, Bruce.
Hello there.
First of all, could you tell us about the aim of Murray International and how you go about achieving your objective and getting a good outcome for shareholders?
So the aim of Murray International is to achieve an above average dividend yield and to grow the dividend and the capital ahead of inflation over time. That's the aim of the company. How we go about it is to maintain a diversified portfolio. It's bottom up, so we're looking to buy good businesses that will deliver capital growth and income growth over time. And it's very concentrated. There's only around about 50 stocks in the trust at the moment. So it's not following any benchmark. It's very much bottom-up focused.
Okay, I mean the pandemic has had a massive impact on markets. Obviously, the past number of months, and subsequent decision by many companies to either cancel or cut dividend payments. I mean, how has that affected your investments?
Yeah, I mean, we've never seen anything like this before in our life, where there's been a raft of dividend cuts for all sorts of reasons. For companies that got too much debt, can't afford it. For companies that maybe still have good balance sheets but have just become very cautious about liquidity. And we've also had political intervention, we've had regulator intervention to suspend and cancel dividends. So really quite extraordinary circumstances over the last 6 months. And Murray International has not been, completely immune from that either, even though our exposure to the developed world is a bit lower than some other trusts. But in things like at the airports that we own, both Auckland Airport and ASUR in Mexico, then they cancelled the dividends. And we do have a position in Standard Chartered, it cancelled its dividends. So it has been tough from that point of view. But on the positive side, things like the Asian banks, continue to pay healthy dividends, as do lots of the other businesses that we own. But it's been a tough environment.
So when you're looking to invest in new stocks, for example, now, and you're doing your research, are you finding it harder to find companies that support the trust yield requirement?
Well, there's certainly been a change in where you get income in a global investment trust nowadays. In the developed world, where you've seen a real flattening of yield curves, really over the last 30 years ago, the 10-year gilt yielded 12% in the UK, and today it's closer to 12 basis points. So you can see the downward pressure on yields, and that's been reflected in corporate dividends as well that have gone lower. But at the same time as that's been happening, we've seen in the more orthodox areas of the world, like places like India, places like Indonesia, where bond yield curves are normal looking, so a 5 or 6% 10-year bond yield sovereign debt is there, and therefore an equity that yields maybe 4 or 4.5%. It doesn't look unreasonable or out of line. And of course, if it's well financed because the company's got a strong financial position, then it's very attractive indeed. So yes, we can still find those companies, but we have to look further afield.
So obviously the market sell-off since March has seen share prices certainly sort of fall sharply. What assets have you been buying and selling recently, and did you take advantage of those lower prices during the worst of the March sell-off?
Yeah, well, March was a very interesting month, wasn't it? Especially in terms of volatility, and it was definitely a month to become detached emotionally, if you could be. Going into the year, Murray International was de-geared from equity, so we owned about 18% in emerging market debt bonds. So once the equity market started to unravel, we took the opportunity to sell about 5% of short-dated sovereign bonds, mainly in Indonesia and Brazil, that had held up extremely well during that period, and reinvested that money in equities. So having been 94% in equities, we're now about 99%. And of course, the valuations look very attractive. The dividend yield looked very attractive in businesses, that the dividends were most certainly there. And so we initiated new positions in things like AbbVie, the global pharmaceutical company, Broadcom, global semiconductor company, Ping An Insurance in China, and China Resources Land. So it's been a very active period for Mint during this time. We've taken advantage of it.
Look, in a statement you issued last month, you urged great caution as the world emerges from lockdown, and you also raised concerns about the massive increase in the developed world's debt burden. But you said the trust would continue to look for opportunities, and I quote, fiscally prudent and savings-rich nations within Asia and emerging markets. I just wondered, could you explain what you mean by that, and which are your favourite emerging markets currently?
I think what that is referring to is that the focus of attention for the world really in the last 3 or 6 months has been about doing whatever it takes to prevent a credit crunch, hence the enormous monetary and fiscal response to coronavirus, and also just to keep economies on their feet, because at no point in the past have we ever seen societies be shut down by government. So a very unusual situation, but at some point in time, somebody has to pay for this. And in terms of the developed world, where there's already significant sovereign debt, significant personal debt, household debt, all over the place, it just makes another headwind in terms of the amount of money that the consumer has for consumption at some point in time. But when we look into many Asian countries and countries in the emerging world where fiscally they're much tighter, they've not had to spend as much money, there's been a lot more savings, then what we really see is a tailwind coming out of this, where the pent-up demand can be satisfied from either savings or increased credit, but where the countries themselves and therefore the populations are not going to be saddled by an enormous cost of this unfortunate event, for years to come. So that's what's attractive about many areas in Asia and some emerging markets today.
Are there any sort of countries that really stand out, and you think that that's where I put my money?
And not really, because we don't actually manage Mint from a country basis. We look to buy companies. I mean, what we're trying to do is find 50 different businesses around the world that do different things, so there's no correlation really between them if possible, and enjoy the growth in capital and dividends over a long period of time. So it's the business rather than the country that's of interest. But obviously, in many parts of Asia, you have demographics that are very favourable, younger populations. But most importantly, you have rising real incomes and rising purchasing power, which is the exact opposite of the developed world today, where you have unfavourable demographics and a real contraction of real spending power.
Okay, now the trust share price has outperformed the wider market over the long term, but it's pretty much in line, I think, with the broader indices in 2020 so far. Why is the trust not outperforming at the moment, do you think?
I think, the question you'd have to ask there is outperforming what? What we're trying to manage are outcomes for the shareholder, and the outcome of the shareholder is the aim of the trust, and therefore is to deliver on the income and deliver on capital growth over time. And it's certainly not been an environment that's been easy to grow capital. Some of the broader indices have been positively affected by internet stocks and by technology, which have been extraordinarily strong since the start of the crisis. And there's been an enormous amount of money. So you've seen a real concentration of market performance in particularly a small number of tech stocks. And any portfolio where there's diversification, it's been much more of a struggle. But that's in a very shorter time period, and we have to take a longer term view. And the world still needs commodities, metals, mining, construction, house building, all sorts of products, whereas we're focused there. The markets have been very concentrated.
Bruce Stout from Murray International, thanks very much for joining us today.
Thank you very much.